How is rental income taxed when you have a mortgage? Owning rental property has positive benefits. One of those benefits could be potential cash flow from tenant payments. However, most incomes are subject to some kind of tax, and rental income is no different. But if you took out a mortgage to buy or refinance your rental property, how is your rental income taxed? The answer is that your rental income is taxed as ordinary income, whether the property carries a mortgage or not. But it might be possible to lower rental or other income with mortgage expenses. The IRS and rental income. According to the IRS, rental income is defined as any payment you receive for the use or occupation of property. So when your tenant hands over the monthly check in accordance with the lease you both signed, that's rental income. It's also income taxed according to your particular tax bracket. Rental income extends beyond a monthly check. Advance rent and non-refundable security deposits also fall into this bucket. So does payment from your tenant for canceling the lease. What if a tenant pays any expenses like utilities or maintenance? This is also considered rental income. Mortgage interest and other potential deductions. How does your mortgage figure into your rental income? The mortgage principal, in other words, the amount you borrowed to buy or refinance your rental property, can't be used to write off rental income. The principal is added to your property's basis, where it's depreciated over 27.5 years, if it's a residential property. But the added component of a mortgage, specifically the mortgage's interest and insurance premiums, can be used to help reduce taxable rental income. Other mortgage-related tools that could be useful in offsetting taxable rental income include mortgage interest payments on loans used to improve your rental property, and credit card interest generated by goods or services used for your property. There's another caveat to mortgage interest deductions. Specifically, if you live in that rental property for part of the year, you can't claim mortgage interest expense as a deduction while you live there. For instance, if you buy a vacation home with a mortgage and live in it for 3 months of the year while renting it out for the other 9 months, you can't use mortgage interest deductions or other deductible expenses while you live in that home. Taxes are taxes. Whether you bought a rental property with cash or a mortgage, you will be taxed on that rental income. A mortgage doesn't really enter into the situation. However, expenses connected with the mortgage, again, not the principal alone, may be used to offset some of that rental income. To ensure you follow IRS rules, contact your tax advisor for assistance. Realized can help you create a strategy to make your lifestyle goals a reality. For more, please visit the links in the description. Thanks for listening.